Now it's time for Safeguard Your Money with Michael Andersen, RIA.
Good morning. Welcome to Safeguarding Your Money. My name is Michael Andersen, and I'll be your host for the next 30 minutes or so. As I've mentioned in previous radio shows, I'm an investment advisor by trade, with offices in Easton, Cambridge, and in Annapolis. But I'm also a longtime financial educator, offering a variety of classes on retirement planning, Social Security planning, income planning, tax-free planning, and a host of other topics. Over the years, I have personally taught thousands of people, just like you, how to achieve financial success. I hope today I can continue that theme. By the way, if you need to reach me, you can do so Monday through Friday from 8:30 a.m. to 4 p.m. at 410-690-4894 or anytime through my website, safeguardmoney.com. Okay, let's go ahead and get started with today's show. If you're listening this morning and have participated in one of my classes before, you've probably heard me say that we all make our best decisions when we're well informed. That's why this morning I want to do something a little special and respond to specific questions about personal financial issues. Normally, this show's format is based on my personal opinion on what would be worth discussing. Today, we will do the opposite. I'm very proud that I can answer some of your specific questions. Just so you know, I polled my clients as well as students in one of my recent classes just for today's show. I asked them what topics they would want covered, what questions they have that they would like answered on the air, and I got quite a few responses to this query. Today, I aim to cover some of these. Now, bear in mind that in financial issues, it's rarely black or white. For example, if someone comes to my office and simply asks me at what age they should start taking Social Security benefits, my answer would be, it depends. I say it depends a lot because everyone's situation is unique. Your finances are different from your neighbors, different from your coworkers, different from your golfing buddies. Every situation deserves a personal answer. Now, not every financial professional will say that. Some will give blanket answers with very little background information. Think for a minute about the famous financial professionals. People like Susie Orman and Dave Ramsey. Often, people will call in to their radio or television shows, ask a very short question, and then the personality will offer an answer. In those instances, I think the supposed gurus aren't helping at all. In fact, they're doing a disservice, in my opinion, because they're giving advice that many people will blindly follow without knowing enough about the individual situation to give the best personal advice. Now remember, we do best when we're well informed. That includes when the professional is answering a question. He or she needs to be well informed about your situation in order to give you the best advice. Is that fair enough? So, over the next few minutes, I'll share with you some questions that my clients and students in a recent class asked and how I might answer them. As always, you are strongly encouraged to seek professional help before making any major financial decisions. So let's go ahead and get started. Our first question comes from Jim and Robin Schweppe. They ask, is hard currency, gold or silver, important in a standard investment portfolio? I think that is an outstanding question, and I want to thank Jim and Robin for asking it. I think quite a few people are wondering what role gold and silver could play in their portfolio. What's interesting to me is that in the mid-2000s, before the real estate crash and extensive government interventions into the economy, I was rarely asked about precious metals. But now, I'm asked it all the time. Sure, there are a lot of television and radio commercials selling gold and silver nowadays, and I wouldn't be surprised if some of the interest in metals is because of marketing campaigns. But I also think that when a lot of people all start thinking along the same lines, there's a reason for it. So I think we need to ask ourselves here what owning gold and silver and other hard currencies would hopefully accomplish. And I think there are a couple of objectives. The first would be as a hedge against inflation. As many of you probably know, the Federal Reserve is printing a lot of money these days. Now, they don't call it that. They call it quantitative easing. But it's really just printing money. Now, when the amount of money in circulation expands quickly, the existing currency loses value, and goods and services therefore become more expensive. We call this inflation. Holding paper dollars is a near guarantee over time that they will lose value. Over time, hard assets like gold and silver have shown a correlation to inflation. Essentially, as inflation is created by the Fed, many hope that gold and silver hold their absolute value. Now, we've got to be careful here because their value is based on supply and demand, so it can fluctuate all the time. This inflation hedge, therefore, takes place over time, and more on this in just a minute. Another objective to owning gold and silver would be to maintain privacy. In an age when we hear about government snooping into our private lives, tapping phone lines, and so on, a lot of people are nervous about having money in accounts that are registered and known to the government. Now, I'm not here to say you should or shouldn't have these concerns, only that some people have voiced them to me, and I'm sharing what I've heard. But in terms of privacy, gold is really just a lump of yellow metal, the purchase of which from a dealer might be known to the government, but the transfer of it to someone else isn't necessarily a reportable event. Now, please be careful here to understand laws on asset transfers and gifting. I always encourage you to obey the law, including the federal gift tax law. Third point about precious metals. How are they valued? I mean, obviously we know that a bar of gold is only worth what you can sell it for. But if you look at stocks in contrast, you can see that there are some other metrics that suggest possible valuation. For example, some stocks pay dividends. Stocks have price-to-earning ratios, price-to-book ratios, book values, and so on. Gold? Nah. Gold is just a yellow metal without a so-called working value. Its value is purely subjective. It is worth what someone is willing to pay you for it, and nothing more. Therefore, how can we even guesstimate its future value? We can't. It's pure speculation. I also want to add one final point about precious metals, and that is they are not necessarily liquid. Not many businesses that I know of, such as the grocery store or a restaurant, will accept payment in gold. So if you have a lot of your wealth tied up in gold, what you have is an illiquid asset. Now, please be aware that the ability to convert a precious metal into a more usable currency isn't guaranteed, nor is the market value immune to significant fluctuations should you attempt to convert metals into currencies. There are, of course, many other aspects to precious metals ownership. I hope my answer to Jim and Robin's question was helpful. If you're curious, I bet you that a quick Google search will yield a lot of interesting thoughts on gold and silver ownership. Now, if you're just tuning in, my name is Michael Andersen, and this is Safeguarding Your Money. In our time together today, I'm answering questions about financial topics that have been posed to me by my clients and also my students at a recent retirement planning class that I taught. If you have a follow-up question to material I cover this morning, or you just need to reach me in general, please call 410-690-4894. Okay, let's go ahead and get back to our program. Our next question is posed by Eugene Williams. Gene asks, what would be the best way to invest a pension plan payout if you are 66 years old and retiring? You know what? That is another outstanding question. But I want to rephrase it slightly to say 66 years young. You see, retirement today for many people is an opportunity to do amazing things. People who retire today have incredible choices, and with the proper financial planning, they can take advantage of many of them and have the best and most fun years of their lives. Now, if a client comes to me at 66, this tells me they're probably at or really close to their full retirement age for Social Security. Among other things, this gives the client the ability to earn as much as he wants from a new job without his Social Security benefit being reduced. So we've got some flexibility there. He may not need that pension payout if he's choosing to go back to work. But let's suppose that the client is planning to fully retire at that point and wants to know whether he should start his monthly pension payout or roll it into an IRA as a lump sum. In my opinion, one of the first items to focus on here before a potentially irreversible decision is made is a cash flow analysis. In my office, I have software that helps me examine cash flows for my clients to determine when someone retires if they will have enough regular income to comfortably pay their bills each month, with the key word being comfortably. In my experience, most people need more income than Social Security itself provides. So once we know how much more, then we can determine the smartest way to generate it. The company monthly pension payout may be just right. It may be too little income, or even too much, depending on the client's needs and the pension itself. Now remember, pensions are set up by the employer with unique rules, payout percentages, cost of living adjustments, and other features. To find out the rules, payout scenarios, cost of living adjustments, and all of the other features, a client should get a copy of their pension's summary plan guide, which is essentially the rules of the pension as set up by the employer. If you're working with an advisor, such as me, make sure you bring in a copy of that guide when you come in to discuss your pension. Now, once we know what the pension offers, a question to get answered is whether the client can do better in the private marketplace by purchasing a guaranteed annuity. Frankly, sometimes the pension is best and the client should keep it, whereas in other instances, the annuity is better. It really all depends on the circumstances and rules of the pension. Anyway, the other option would be to roll the pension into a lump sum, most likely into an IRA so it remains tax deferred. Once in an IRA, then the advisor and client can craft a portfolio mix that best suits the client's unique goals and risk tolerance. Ladies and gentlemen, I have helped many people with pension decisions. If you have a pension and are unsure what to do about it, I invite you to make an appointment with me so we can run some numbers and determine what might be the smartest course of action. I strongly encourage you to seek the professional assistance because most pension payouts, whether they're lump sum rollovers or monthly streams of income, are irreversible decisions. So it's critical, in my opinion, to work with an advisor who can give you the best information and who is experienced in this area. And that information will come when he knows all about your personal financial situation. We truly make our best decisions when we're well informed, and that includes the advice the advisor may be able to give you. So again, many thanks to Gene Williams for that outstanding question. Now, before we move on to our final question today, I just want to reintroduce myself for those who may just be listening. My name is Michael Andersen, and this is the Safeguarding Your Money Show. In today's show, we're answering questions that have been posed to me by some of my clients and by students in a recent retirement planning class that I taught. If you have a question about your own finances, please feel free to call my office for a complimentary 60-minute appointment. I have offices in Easton, Cambridge, and in Annapolis. My phone number is 410-690-4894, or you can visit my website at safeguardmoney.com. Okay, so let's get started with our last question. I think I've saved the best for last. Our final question is asked by one of the savviest people I've ever met, a gentleman named Spencer Garrett. Every time I see Spencer, he is spot on with his thoughts and analysis of financial issues. So it comes as no surprise to me that his question for this radio program is an outstanding one. He asks, I'm 68 years old and retired. Most of my retirement savings are in IRAs. What strategies should be considered as I approach the required minimum distribution age of 70 and a half? Again, this is just an outstanding question because, frankly, most of the people I've met over the years, that I've worked as a financial advisor have most of their life savings inside of 401ks and IRAs and other types of qualified accounts. And this makes sense because with these accounts, taxation is deferred until a withdrawal is taken. Some people choose to take withdrawals when they retire, maybe because they need a regular stream of income to live on, or maybe just periodically for fun things like vacations. Other people don't take withdrawals at all, but just after turning 70 and a half, the government makes you take money out. This is what's called a required minimum distribution. Many clients have told me they don't want to take out required distributions because they don't want to pay taxes. In fact, people often tell me they prefer to leave their savings to their family, not have the government confiscate large chunks of it through taxation. And who can blame them? One of the neatest strategies to handle RMD taxation is one of the simplest concepts. Don't take RMDs. Now, I'm not saying disobey the law. I'm suggesting that you change the tax status of the money from pre-tax to post-tax. You can do this through a Roth conversion or through what I call a synthetic Roth conversion. What's the difference? Well, in a Roth conversion, you pay taxes on the amount of money that you're converting into a Roth. But of course, once the account is a Roth, you never pay taxes again, and you never have a distribution requirement. Now, a synthetic Roth conversion, which is my term for this, a synthetic Roth conversion isn't really a Roth at all, but it's another type of an account where the taxes are pretty much taken care of for you, meaning the money goes from pre-tax to post-tax, but you don't have to yourself come up with the cash to pay the government. Like a Roth, there's no distribution requirement, and if you set it up properly, taxes are never due. I have a brand new workshop that I've just started to give on how to set up synthetic Roth conversions. The workshop is called Tax-Free Income for Life, and you can find the details of it on my website, safeguardmoney.com. If you're in a position where you want to not pay the government, then this may be a workshop you don't want to miss. I also have several articles in my office from third-party sources which discuss synthetic Roth conversions and weigh out for you the pros and cons of it. If you'd like these articles, please call my office for an appointment and we'll have them ready for you. Okay, so let's get back to the question. So let's say you decide to keep your money in an IRA and you do have to take distributions. Here are a couple of things to consider. First, many people may want to roll 401ks, 403bs, and other plan assets into IRAs before 70 and a half. The reason is that any monies left in a plan must have RMDs taken proportionally from that account. Now, you may not want to do that if, say, your 401k is down substantially, but maybe your other accounts are not. In contrast, having your money all in IRAs gives you the flexibility to take your RMD from any account. The IRS mostly cares that you just take the appropriate amount of withdrawal from the IRAs, regardless of which accounts you take it from. Another consideration is how you are invested when you're in a withdrawal scenario. Now, this would generally apply to both required distributions as well as any elective ones. And I'll give you an example here. So let's say we have a 71-year-old who has $100,000 in an IRA, and he chooses to take out $5,000 for a nice vacation to Hawaii. Well, $5,000 is 5% of the $100,000 account's value, which is not an unreasonable withdrawal rate for a 71-year-old. It's fairly sustainable, in my opinion. Of course, after taking out the money, his account would now be worth $95,000. Now, it's conceivable, it's possible, that this gentleman's account is in a money market account or maybe another safe account at the bank. But at age 71, that probably makes little sense because interest rates on fixed safe accounts are so low today that there's a good chance he's losing purchasing power due to the government-created inflation that I mentioned earlier. So in all likelihood, this investor has taken on some level of risk with his money in order to achieve some growth. And this makes sense. His actuarial life expectancy is at least another 15 years, so some growth may be a good idea. So his amount of money, his $95,000, is at risk. Well, since the year 2000, we have had two massive stock market corrections of a little bit over 50% each. Now, should that repeat itself? In our example, now this gentleman's account would be less than $50,000. So let's say that happened and he needed to take out another $5,000. Well, that would represent a little more than 10% of his remaining account value. And that, ladies and gentlemen, is unsustainable. It wouldn't take too much to totally exhaust the account, and then the investor would have nothing left. He would have run out of money. Did you know that the number one fear of Americans retiring today is that they run out of money? And one of the surest ways to do that is to take withdrawals from a declining account. Now, this last point is one that I've addressed repeatedly in previous shows, and it's all about something called sequence risk. I'm not going to go into it in a lot of detail today, but in a snapshot, sequence risk is the very real possibility that just due to bad luck, the market is down right when you start to withdraw money. This can happen even if in the long term your investments are outstanding. I think sequence risk is the biggest risk most people have never heard of. And judging from the two major declines of 2000 to 2002 and 2007 to 2009, when in both instances the market lost about half its value, it can be a devastating risk to not understand. Please visit my website, safeguardmoney.com, and listen to my previous shows where I've addressed sequence risk in detail. The bottom line here, though, is that withdrawals, whether elective or required, should be carefully made. The account being drawn upon should probably be invested for stability as its primary objective, rather than high risk because of the possibility of depletion due to sequence risk. Spencer Garrett, if you're listening to this show, I just want to thank you for asking an outstanding question. Well, it looks like our time is running a little short this morning, so I want to say thank you for joining me. If you missed part of the broadcast, you can find an archive of this show and all of our previous shows online at safeguardmoney.com. As I mentioned, my name is Michael Andersen, and I work as an investment advisor in Easton, Cambridge, and Indianapolis, and I'd be delighted to spend an hour with you in one of my offices to discuss your personal financial questions and concerns. Please call my office at 410-690-4894 to schedule an appointment. And don't forget to check out our website for all the latest educational workshops, including our brand new workshop on creating tax-free income for life. Remember, we all make our best decisions when we're well informed. So thank you and good morning. Now, the information I've shared with you is intended to be of informational and entertainment value. It should not be construed as advice to take or not take a particular course of action. All investments carry at least some type of risk, including the possible risk of principal loss. Please consult a qualified professional and carefully consider all aspects of an investment before investing. Michael Andersen, Registered Investment Advisor, is a Maryland corporation. Our Form ADV Part 2 is available upon written request.
You've been listening to Safeguard Your Money with Michael Andersen, RIA.